Wow, it's that time again already. NFP is back upon us. We're going to have a look at what the market might have in store off of that data. And then we're going to move over to non-manufacturing PMIs, again, a very important US data point, and whether US data is continuing its slight slump that we've seen recently. And today's trading takeout is going to be why you need to be on retail trading forums. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. It literally feels like last week that we had the most recent NFP print, which was 336K. So it was a blowout figure. I think the expected back then was about the same as it is now, 180K. Maybe it was a little bit higher at 220. I can't exactly remember, but it doesn't really matter. When you get a blowout that big, it's showing that there's still quite a lot of job creation going on in the economy. The economy isn't weak. And if you look at a structural sort of, template of the economy, you tend to find that employment is the last thing to go. We've seen the housing market slip. We've seen output slip. Profits are not yet slipping, actually. So we're only halfway through the potential for a negative cycle in the US. I personally think that employment still remains strong, which would absolutely shatter the last week of market movements, because what it would mean is that the Fed has to stay higher for longer. They might think that they're already in restrictive policy, but yesterday we saw, from the analysis in the video, that Powell said he's not entirely confident that they're too restrictive just yet, which could pave the way for more hikes in January. And I'll be watching that very, very closely over the next month or two. I guess the next month now, to see what the market's pricing in there. But I think employment is a massively important figure. And so we can see here that we've got NFP and we've got the US unemployment rate today. I think the unemployment rate is also very, very important. If we do start to see a tick up to 4%, that would probably put the brakes on any sort of belief in a hike in Jan. It would show that it's relatively restrictive. But if we were to see, say, an increase in NFP, but unemployment rate stays at 3.8, 3.9%, then I would argue that, we're going to see the market sell off and there's a bit of a pain trade. And I'll show you what I mean by there being a pain trade here. And that is, if we come and switch over to this. So I was completely wrong yesterday on how the market would behave. I thought this high would be the high. The QRA announcement just led to it just completely shifting to the upside. We traded 34.40. Market's not insane. I just got it wrong. But what we can see here is that this is where the announcement was, 42.20. I think we mentioned that, or it might have just been a little bit lower at 4,200. We mentioned that yesterday. And there's been lots of buying around here. But the thing that people now haven't priced in is that the fact that, the meetings still go on, and if this data surprises to the upside, it could really, really put the brakes on any further rally. And you can see how strenuous and strong the buying's been here. You've got this level where we dipped a little bit as well. So about 42.62 and a quarter. And then 42.20 and 3/4 is the other part of it. And this is quite a nice level here as well, actually. I tend not to look at levels in the ES. I tend to look at the profile, but it is what it is. It kind of amounts to the same stuff. So nice support, turned resistance, turned support again here. There's been lots of buying here. So again, it always comes back to, what is the surprise going to indicate on a change in interest rates? Is the surprise, say if we get a blowout NFP again, is that surprise going to be enough to shift the needle to cause the market to rethink what they're doing? And that is the plan here. I think, if we look at it from a kind of a technical analysis perspective, but from the perspective of what people have been doing, you've got all of this area of support up here. It's a nice big area, it's 40 to 60 ticks. But If you're looking at the S&P 500 CFD, you can trade a smaller position size. You don't have to trade the tick size on the ES, which is $25 per tick. You can indeed obviously trade, micro ES as well, which is $5 a tick. But on the S&P 500 CFD, you can go tiny, I believe. So this is what I'd be looking for, any kind of trade up into this area, looking back down here, as long as the NFP is a blowout. So that is the expected move from my position, or the most probabilistic move from my position. So before we talk about today's data, I just want to focus again on the poor manufacturing PMIs that came out in September. Came out just a couple of days ago, but were for the September reading basically. So it was 46.7, which was 2.3 percentage points lower than the reading of 49 recorded in September. Anything below 50 on a diffusion index, which is the PMIs, is contractionary. So the market is effectively contracting. So I guess it's not really a market. The survey is contracting, if you like. Today, we have the non-manufacturing PMIs, which are, where are they gone? Here we go. So the expected number is 53. Again, it depends on the level of surprise. If we get 52, that's not really going to be that big a deal. If we start getting 50, 49, especially 49, anything under 50, then that's going to be a big deal. That will be at contra with the US unemployment rate. So if you get a higher unemployment rate and a lower non-manufacturing PMI, that's kind of what the Fed wants, weirdly. They don't necessarily want strong data right now. Whereas if you were to get a strong manufacturing PMI and a weak unemployment rate, then the Fed really don't want that, because that basically means more inflation. They have to hike more. So this is really, again, another data point today, which has some nuance to it and requires understanding of two different data points at once alongside the Fed's aims. So it's a tricky business, this one, but everything now is pointing towards what the market looks like it wants to price for January. And that is really where the focus is going to be, as I said previously. Again, aligning this with the previous data of the NFP, it could be a messy afternoon. It could end up being a messy afternoon depending on the level of surprise. So focus exactly on that. If you get strong non-manufacturing PMI and strong non-farm payrolls, stronger or weaker unemployment, if you like, so a number around 3.8%, negative on risk, very negative on risk. If you get an unwinding of that or a mixed bag, then it's kind of middling. It's probably good for risk. So just focus on those two. So the trading takeout today is why you need to study what's going on in trading communities. And it's purely for the perspective of, okay, trading is quite solitary and you need to be able to understand what your counterparties, I guess, are doing. And the best way to see what people are doing wrong is to look at all of the trades that they put online for whatever reason they do it for. I've got a spreadsheet full of people who make bad calls, basically. And it's a fantastic resource because whenever they have a call coming up, I can say, okay, well, what is the probability that in this market they're not that good? And if it's high, then I'll just go against them. I'll go against their call. And you can start to develop this process and understanding of, okay, well, what are people doing wrong here? And, they're talking about, what market's this? Aussie dollar, okay? Pound dollar, okay, so there's two pairs that are relatively tightly correlated there because they're both risk positive. Someone's even shown their account size there, which definitely means that you should go against what they do. And then we've got, again, the euro. So you can understand what these guys are talking about because they love to display exactly what they're doing at all times. And it's your job to then decipher what they're doing wrong, because this is what a retail brokerage might do if they want to go against their uninformed flow. Understand what they're doing wrong and then create your own nuances based off of that.